Hello everyone, welcome to the second session of our stock market. So guys, in the first session, I have discussed about what is SEBI, Securities and Exchange Board of India. We have discussed the roles and responsibilities of SEBI. Okay, we have discussed the roles and responsibilities of SEBI, where basically the government of India has formulated a organization like SEBI to make sure that they'll take care of the capital market issues, what is happening in our country. So whenever any company do the public issue, means they become a public company. If they want to become a public company, the first organization which they need to take permission is the SEBI, and that's why the SEBI roles and responsibility become very prominent, because normal individuals don't have all the knowledge to understand that if any company is coming to the public and taking money for the public, then is that company a genuine company or not? So is should we allow such kind of issues or not? That's why we have an organization like SEBI, and SEBI is the regulator of the capital market. SEBI is basically the regulator of our capital market, and SEBI makes sure that any company which try to become a public company, they should have a reasonable years of experience in their corporate excellence. And then if they're coming to raise money from the public, then automatically that company would become a public company. And if any company is becoming a public company, then the company has to do lot of transformations, which are mentioned in the Companies Act of 2013. A public company need to have minimum one-third board of the independent board of directors, and in a public company has to disclose their audited result every quarterly for the public to understand how they have performed so far in last quarter, and a lot of other regulations a public company has to follow, and everything is monitored by SEBI. At the same time, SEBI makes sure that the common individuals like you and me who want to participate in the stock market, to take trade or to invest money, we should be guided properly. Some kind of fin influencers are there which are very prominent nowadays in social media. If they are talking or promising some kind of values to the common people, common retail investor in the name of stock market, that should be done appropriately. So to take care of the rights and the protections of the common people, fund SEBI is there. SEBI makes sure that the every company works for the best interest of the public, and any kind of intermediary or any kind of person who want to act like as a financial educator, he or she should have a minimum knowledge to behave appropriately in the market. That's why we have SEBI. So we have discussed about SEBI in the last class. I have discussed the concept of dematerialization in the market. I have discussed the concept of dematerialization. Basically, when the SEBI was formulated under the SEBI Act of 1992, it was discussed to that how we can make sure that the further scams should not happen in the market. Okay, for that SEBI came up with an proposal to have electronic form of trading, and to have an electronic form of trading, we need to have a something called demat account. So when we talk about demat account basically means dematerialized account, and the organization responsible for the demat accounts are depositories. Okay, we have two depositories in our country. We have NSDL and we have CDSL. Okay, so when we talk about NSDL, NSDL stand for National Securities Depository Limited, and CDSL stand for Central Depository Services Limited. So these two depositories, whenever we are buying any shares in the market, our shares is stored under these depositories. So these depositories give you the cloud infrastructure where all your transactions related to the stock market, your shares, everything is stored there. So because we have these depositories, so we have our brokers who act like a depository participants, and they do all the KYC work for these depositories whenever the new person open Demat account with them. So if a new person opens a Demat account, then and these depositories do all possible when any person want to open a new Demat account with these depositories, since these depositories cannot reach to you to help you with the Demat account opening, then we have the depository participants like Angel One, Zerodha, Carvi, or Money Control, or whatever, Fires, Dhan. What they will do, they will guide us whenever we want to open a Demat account, because they're acting like a depository participants. Okay, and once your Demat account is open, why we have opened the Demat account? So that whatever shares we'll buy or sell, ultimately that can be stored there. Now, how will you buy? Because then the same depositories under whom we have a depository participants, these depository participant then act like a then they act like a broker, and then they'll give you the kind of platform that once you have a Demat account, then along with the Demat account, our broker gives us the trading account, and because of the trading account, now we can trade on the market. Now when we can trade in the market, we can buy and sell shares, and when we buy and sell shares, we'll pay brokerage to our brokers. So we have understood the concept of dematerialization, Demat account. We have understood the roles and responsibilities of SEBI. We have discussed about capital issue, like whenever the company is looking to raise the money from the market, they can raise money by debt. In the case of debt, ownership is transferred, and in the case of debt, uh, the debt is issued for a definite time period. And while when we talk about equity, equity basically means when the company gives their ownership to the other individuals, and when the company do so in the public market, then they do in the form of share. And when we talk about share, share represent what? Share represent per unit ownership of the company. Share represent per unit ownership of the firm of the firm, which they dilute, which they dilute, which they dilute at the time of public issue, which they dilute at the time of public issue. Okay, so this per unit ownership of the company is called a share. So I hope you have understood about uh, these things. Okay, so basically, whenever any company is looking to raise fund from the market, and if they want to raise fund by equity, then the company have two options. They can go with internal equity. They can go with the internal equity. Internal equity means they can use their reserve and surplus. They can use their reserve and surplus, and from their reserve and surplus, they can raise money, or they can follow external equity, or they can follow external equity to raise money. So internal equity basically means reserve and surplus. A reserve and surplus, how the company get, because the retained earning, the part of earning what the company have at the end of the day, this retained earning year on year basis, they'll put into the saving account, which is basically the reserve and surplus account. You can see reserve and surplus account of a company in their balance sheet under the liability side. So under the liability side of the balance sheet, you have equity part and you have long-term debt part. So under the equity part, you can see the reserve and surplus of the company. So every year, whatever the profit the company get, some part of the profit they give to the shareholder as as in the form of dividend, and remaining part what they retained with themselves. Okay, this remaining part year on year basis, when it is accumulated, form the reserve and surplus of the company. So one way the company can raise money by equity, either by using the internal equity, or they can do through external equity. External equity means if the company uh, try to raise money externally by diluting their ownership in the market, and that time they have to do two ways. Either they can do a private equity, or they can do a public equity. So when we say private equity, basically means private equity The examples of private equity is private placement, or it can be preferential allotment. Okay, so private placement basically means if a private company raise money privately where the ownership pattern does not change, they go to some venture capitalist or money lender, uh, and there they pitch their business plan to them, and then if anyone is interested with their business plan, they'll buy certain percentage of the ownership where the ownership pattern of the company does not change. A private company would be still as a private company. Then that way of raising fund is called private placement, while preferential allotment basically means that if a public company, means the company has done the IPO, and now maybe the company is not believing that this is not the right time to raise money from the market. Maybe there's a public company and they have still requirement of some fund. Now, in order to get that the fund, the, the company has two options. The company can go to the public. Once a company become a public company, then what they have an option that they can do a right issue. Once you are a public company, you can do a right issue where you can target your existing shareholder, and you can raise money from them. Okay, so you don't go and ask new people. You can raise money from existing shareholder, whatever fund you have, whatever fund requirement you have, based on the percentage of the share the individuals are owing. Then that is called right issue. And the other way, what they can do is FPO. FPO is done after IPO, means once the company is a public company, they cannot do a IPO again, because IPO can be done only once. IPO basically means initial public offering. So once the IPO of the company is done, they cannot do the IPO again. But they are a public company, they are trading in the market, secondary market. Okay, what the company can do, instead of raising money privately, or they can follow the same steps what they have followed in the IPO. Only thing is that this time it is called as FPO, because IPO can be done only once. FPO can be done n number of times, where through IPO the company can target new customer, new investors or existing shareholder, and from them, if they are trying to raise fund, okay, by following the same process what they have followed in the IPO. Only thing is the name is different, and next thing is that when the company do a FPO, they cannot do at the price at which the share is trading, or they cannot do at the price below the price at which the company share is trading. Maybe suppose there's a company which shares are trading at 100 rupees in the market. Okay, and they want some money from the public. Okay, and they're ready to give their share to the public, and they want public to buy their share. So if the shares is already trading at 100 rupees, and if they're ready to give you more shares, maybe at 100 or less than 100, who the hell will be investing you? Because your shares is already at 100 rupees. If somebody want your share, they can buy from the secondary market at 100 rupees. Why they'll take the money? Why they'll take the share from you as a promoter? For that, you have to give the share a little bit lesser than 100 rupees. If your share is trading at 100 rupees, if I am need of fund, okay, so what I will do, I'll say that, dude, I'll give you my share of 90 rupees. Okay, I'll give my share at 90 rupees, and give me 90 rupees and take one share of my company. Because in market, my share is at 100 rupees. In the market, my shares are already trading at 100 rupees. So if anyone want my share, they can buy from 100 rupees in the secondary market. If I want money from them, then I have to give them my share at a price lesser than what is trading in the market. Then only somebody would be interested now to buy the share of my company. So whenever any company do an FPO, they do an FPO at the price lesser than the current market price of the share of the company. So that way, FPO can be done where the company can target existing or new shareholder, and from them the company can raise money from the market. Okay, IPO basically means first time when the company is raising fund from the market. First time, if the company raising fund from the market, then it is called as IPO. And once the IPO is done, basically these are done in the market which we called as the primary market. So basically, when the issue is done, automatically the company would become a public company. And whenever any company become a public company, they have to list themselves on the stock exchange. So within 7 to 10 days of the IPO, the company has to put themselves on the stock exchange. That part you have to understand. So imagine when the economic condition is not that favorable, maybe the stock market every day is falling down, that what is happening right now. Okay, that time, many time the company don't prefer to go to the public, where if a public company, okay, if a public company do a private issue, if a public company do a private issue where instead of going to the public and raising money from them in the form of equity, if a company raise money privately from some money lender or through some bank or through some private equity company through a block deal or some kind of arrangement, then it is called as preferential allotment. So there are different ways are there. A company can raise a fund from equity. Okay, so we have discussed in the last class about CB, we have discussed about the concept of dematerialization, why we need to have this concept of dematerialization. Because when we are trading electronically, when we're trading in an internet globalized world, which is connected with rest of the world, so every piece of information what is coming into the market within the fraction of second, it get transferred all over the world, and everyone have should have not should everyone is actually having the access of all possible information because of internet. And imagine if somebody is using some kind of information which is not there in the public domain, some kind of information which might come or might reveal in the future, maybe after 1 day or maybe after 1 hour, or if you have the access of that information before the public actually having, and by using that information, if you take some trading decisions which gives you an undue advantage, then it is called as insider trading. Okay, if anyone is being caught doing insider trading or front running, okay, then it is not considered as a good signal in the market, and such kind of people, SEBI or government of India take actions against them, these kind of people. So you should know about what is insider trading. Okay, so there is a law prevention of insider trading act is there. Okay, you can read about that about them separately to get more idea about this. So we have discussed about SEBI, its roles and responsibilities. We have discussed about the concept of dematerialization, why we need to have depositories like NSDL, CDSL. We have discussed about capital, that that any company when they are in need of fund, they can raise capital by equity and debt. We have discussed the difference between equity and debt, the features of equity and debt, what is share. Okay, the share can be ordinary share, share can be a preference share. Preference share does not offer you the ownership right. Preference shares are redeemable in nature. Whenever they issued in the market, they are always issued with a definite time period. Okay, after which they are bought back by the company. The other way, the other kind of share is called ordinary share. Ordinary share represent the true ownership of the company. And when we are having the share of the company in the form of ordinary share, then we can hold the share till whatever time we want. The ordinary share represent the true ownership of your organization, where you get the voting right, where you get the dividend, where you will get all other corporate benefits if the company gives in the form of bonus, stock split, all possible benefits an individual can get when they are holding the share, and they can hold the share till infinite time period. That's why whenever any company does an IPO, within 7 to 10 days, they have to list themselves on the stock market, because the share what the public got, the life of that share is infinite. So tomorrow, if the public want to buy more share, or if they are not happy with the company performance, if they want to sell off that share in the market, then all that can be possible if it can be liquidated. If all that is possible, if it liquid in nature, liquid means you can easily buy or sell them, and that is possible because we have a stock exchange. So we have two stock exchange in our country. We have discussed about stock exchanges. We have two stock exchange in our country. Okay, we have Bombay Stock Exchange and we have National Stock Exchange. And these stock exchange operates from 9 o'clock in the morning till 3:30 in the PM. So within this time, we can buy or sell any share of the company. And whoever we want, we can buy and sell their shares. Okay. The moment we buy any share of the company, within the end of the day, we'll get the proof of the trade, which we'll call as a contract note. The contract note is the proof of the trade which your depository, okay, NSDL or CDSL will send you so the mail as a proof that you have traded on the security, because everything is happening electronically. So the proof what you get about the share of the company which you have bought, at what time you have bought, what was the price of share at that time, how many shares you have bought, what is the value of that investment, everything you get as a proof by the end of the day, which and that statement, the PDF what we get is called as contract note, that can be used as a document. You should save contract note as a printout. If you can keep with you and document in some file, that would be really good. If you are someone who do long-term investment in the market, if you are swing trader, or if you are just doing for intraday or something, then it doesn't matter. But if you are someone who is actually planning to hold the share of the company for long term, then it's important that then you should document the work. Okay, normally when we are trading in the market, many people go for intraday trade. So when we do intraday trade is not actual buying or selling the share. It's just about an speculative activity. Intraday trade is just a speculative activity where people try to predict which stocks we have a movement. Okay, to see which stocks you have a movement, you can use the website like Scanex. You can use the screener called Scanex. Okay, this if you have done Demat account, you can use Scanex screener. It will show you the stocks which are in momentum. You can use websites like portal dot trade brains, portal dot trade brains dot in. These websites will show you like which stocks the movement is happening. So by seeing like these kind of stocks, these kind of market where the movement is happening, you can choose the stocks very easily. Then another website you can use is intraday screener. Okay, you can use these stocks intraday screener. You can use this website. There can be infinite websites. I'm telling you those website name which I use for observing the market. Okay, different people observe the market in different domain. Like if I tell you portal.tradebase.in, you can go to this website, and here you can click on heat map. If you click on heat map, if you click on heat map, you can see like Nifty 50, uh, how many companies, the all 50 companies in Nifty 50 which are green, which are red, you can see them. Okay, if you want to see any company which has given plus above plus 5% return, there's no company yesterday. Any company which fall below 5%, that also you can see. Nifty 50 means the best 50 companies, and then Nifty next 50. Nifty next 50 means from 51 to 100. Okay, you can see above 5%, no company below 5%. Yeah, GSW Energy has actually fallen below 5% yesterday, between 51 to 100. Then 2 to minus 2 to 5%. You can see many companies were there. Naukri, ICCI, General Insurance, Siemens, United Spirit, IOC, PNB, Geo Finance, Adani Green, Indigo, LIC, TVS Motors, and RECLT. You can see there are a lot of stocks are there between 2 to 5% minus and plus 2 to 5%. The stock which has given movement were Sri Cement, Godrej Phillips, and Goldfree Phillips and Dabur. Like this, you can change the index and you can see. I hope you understanding this. You can do within the market hour, or you can, if you have Dhanka Demat account, you can open a Scanex. So Scanex, if you open, in order to use Scanex, you need to have a Dhan Demat account. So if you use Scanex, you can there. This will not be visible right now because market is not operating right now. Here you can go to live. and under live you can see the stocks which were giving movement. During live market, using Scanex will definitely will be helpful for you to see or to see to figure out those stocks which are giving good momentum. The other website which I was telling you is intraday screener. So if you get into intraday screener, you can understand about the market. Like you can see what has happened with Nifty 50. Okay, Nifty 50, where it Nifty 50 has closed. Nifty 50 basically represent the movement of best 50 companies which are trading in our country. So primarily these companies which are trading in our country, they are around 2,900 companies which are trading on BSC, NSE, and you can see 2,931. And if you see in BSC, you'll find around 4,000 companies which are trading on Bombay Stock Exchange. You can find around 4,000 companies trading. Now, you have to understand that BSE is very old exchange compared to NSE, but when it comes to trading volume, you'll find more volume in NSE. So imagine that if you want to buy or you want to trade on any stock, okay, it's like I'm showing you, I have account in Fires, Dhan, and other Demat account. I will show you Fires because I generally use Fires for observing the market behavior. So, like, imagine if I'm showing you stock in Fires. Okay, any here, like, suppose Infosys only I want to buy because Infosys looking very good for the Monday market. So suppose here if I search for Infosys, so I have two option. I can buy through NSE or I can buy from BSC. Prefer NSE over BSC. So we have around so many companies which are trading on BSC or NSE. So you need to understand that these companies which are trading over NSEs and BSC, we can divide these companies either based on their market capitalization, or we can divide these companies either based on their business model or sector. So if we talk about based on their market capitalization, market capitalization basically means the price of one share into the total number of shares what they're having. So based on market capitalization, if we divide any company, the company can be either a large cap company or a company can be either a mid cap company. A company can be either large cap company, it can be mid cap company, or it can be small cap company. So large cap companies are those companies which have market capitalization of more than 20,000 crore. They are called as large cap company, and any company which have market capitalization between 5,000 crore to 20,000 crore, we'll call them as a mid cap company. And those companies which have market capitalization less than 5,000 crore, we'll call them as a small cap companies. So either we can divide the companies which are trading on the market based on their market capitalization, or we can divide them based on their business model. So based on business model, if we divide the company, they can belong to IT sector, they can belong to banking sector, or they can belong to pharma sector, or they can belong to mining sector, they can belong to metal sector, they can belong to cement sector, they can belong to oil and gas sector, they can belong to media, they can belong to IT, they can belong to FMCG, they can belong to automobile, they can belong to real estate. There are a lot of sectors are there. Primarily, what we have done that we have grouped these companies, and we have formed a index based on the group. Okay, singular word is index and plural word is indices. So lot of index is being created. So one of the index is Nifty 50. So when we say Nifty basically it is a portfolio of all the companies. Whenever you hear the word Nifty basically means that it represent the best 50 companies which are trading on National Stock Exchange. Then we have Sensex. Sensex is the portfolio of best 30 companies which are trading on BSE. Nifty is the portfolio of best 50 companies which are trading on NSE. So if you want to see these best 30 or best 50 companies, you can go to nseindia.com. If you go under nseindia.com market data indices, so under market data indices, if you click on Nifty 50, you can see these best 50 companies which are trading on our market. You can see their movement. If you want, you can even download their data. Here, download option is there, download.csv. So you can even download their data. Okay, and to under to one minute, it has not opened so far. So you can if you want if you want to see those it's taking time to, so if you click on Nifty 50, so under Nifty 50, you can see primarily the stocks which are the best 50 companies. These best 50 company stocks represent different sector. You have Britannia, which is belong to FMCG. You have ICICI Bank, which is a bank. You have Nestle, which is FMCG. Infosys, which is IT, HCL, IT, TCS, IT, Hindalco, Metal, ITC, FMCG, Bharti Airtel, Telecom, Maruti, Automobile, Reliance. You have Reliance Oil and Gas, Wipro, IT, Hindustan Unilever, FMCG, HDFC Bank, Tata Consumer, Bajaj Finance, Asian Paint. So you can see these are the best 50 companies which have worked, which are working on the market. These are the best 50 companies, and to measure the relative movement of these 50 companies with respect to each other, you can even download the data and you can do the analysis from your end if you want. You can see these are the best 50 companies. Like this, there are many groups we have made. Nifty 50 represent the movement of best 50 companies. Then we have Nifty Next 50, which represent from 51 to 100 companies. We have Nifty 100, which is from 1 to 100. It is a sum of Nifty 50 plus Nifty Next 50. Then you have Nifty 200. In Nifty 200, you have best 100 companies, which are the large cap company. And then from 101 to 200 are your mid cap companies. Like this, you have lot of indices. You can see India VIX. India VIX basically measures the volatility in the market. Okay, so ideally your India VIX should not be more than 14. If you're seeing an India VIX more than 14 means it is talking about volatile market. Okay, that's why if you see intraday screener, you can see that they're showing extreme fear in the market. Okay, so there are a lot of indexes there. Primarily, what the investor use for the trading purpose is Nifty 50, and you have Bank Nifty. Then you have Nifty Mid Cap 100. So Mid Cap Nifty, when we say, so it's a portfolio of best 100 mid cap companies. Then you have Nifty Small Cap 50. So it's a portfolio of best 100 small cap companies. Then you have Fin Nifty. So you can see this. Then you can see the activity in the market. So, because our market is more influenced by the activities of FII and DIIs, so how much they have done buying or selling, you can see there. You can see advanced decline FNO. So you can say out of 227 FNO companies, 23 are in only green, while 200 FNO stocks are in red. You can see the news here, what all news are there. Here you can see the sector overview. Okay, Nifty, IT, whichever sector you can click. Okay, you can see them. Okay, the IT sector, you can see Infosys, TCS, HCL, they are in green. Rest other IT companies are in red only. If I see Nifty Media, in media, all companies are in red. Okay, if you see pharma except Pfizer, all in red. So one by one, you can see same wise in healthcare, except Max Health or in red. Then in energy sector, except Reliance or in red. So bank, PSU bank, all PSU bank were in red only. So you can see like this, you can click on sectors, you can see them. Broader index, if you do, you can see the broader index, Nifty 50, Nifty Bank, mid cap, small cap, everything you can see. That will give you an idea about what has happened in the market. So every day when your market get closed, you can watch them. And that will give you an idea. Uh, here you can see intraday purpose. Uh, what is happening with the stock, best intraday stocks. You want to see best intraday stocks. They'll tell you the best intraday stocks. Nothing has came. Then support and resistance level. So any stock you want to see the support and resistance level at what price they are traded, then what is R1, R2. I'll explain about R1, R2, OI, VWAP, ADX, RSI, 20-day moving average, 100-day moving average, 200-day moving average. Like you see, Goldfield Phillips is doing very well. So it's looking very positive. Then you have Inga Grant, which is looking very positive. So like here you can see the stock support resistance level can help you decide entry, exit and stop loss where you can enter right now, where it is trading, where you can enter like KPIL. It is traded on 879. You can enter after 1,000 rupees and your first target would be 1,016 and your next target would be 1,032. You can see this. Jyoti CNC, Netco Pharma. You can see these stocks and what is happening, how much is the momentum. And you can see this. Fine. So here, like here you can see intraday support momentum stocks. So they it have lot of features. You can spend some time among yourself within the market hour. You can spend some time. Top gainer, top loser, top intraday gainer, top intraday loser, top gap up, top gap down. You can run screener also. Lot of screeners they have within the market hour. You can see the stocks if any stocks are coming. So basically, they will become more, they look more attractive when the market is actually working. So once the market is closed, you will not find it too much attractive. So you have these companies. You can go through this screener like ScanX, or you can go to intraday screener, or you can go to portal.tradebrains.in. These websites would help you to identify the stocks where you can have a momentum. So many people who do intraday trade, they basically prefer these kind of websites. So normally when we trade in intraday, we actually not buying. We are not gonna get the ownership of the company. So whenever we perform intraday trade, we can either buy any company share or we can exit by 3:15 p.m. We have to exit by 3:15 p.m. Or what we can do, we can sell any share. If any stock is falling down, we through these websites we get to know which stocks are rising, which stocks are falling. So whichever stocks are rising, which we see potential is there, we can buy those shares, and whichever stocks are falling, if we see that yeah there's a potential that they can fall down, we can sell this share and we can exit. If we are selling this share, you cannot hold the share, because in normal trading you cannot hold the share beyond 1 day trading. So you can do this short selling. This is called as short selling. You can do a short selling, but you have to exit by 3:15 p.m. The trade you have to exit by 3:15 p.m. Okay, because if you don't exit, your broker will make you exit by before that. Okay, and the brokerage, what the broker charge for the intraday trade is comparatively higher than when you trade in delivery. When you are trading in delivery, the brokerage would be zero from many brokers. And whenever you trade in delivery, you have to pay 100% money. Okay, but when you're trading in intraday, you just need to pay 20% of money. Like Infosys, if I want to buy, okay, if Infosys I want to buy, I'll click here. I have two options, either market order or limit order. Market order means at whatever price it is trading in the market, at that price I can buy the share of the company. Okay, that is called as market order. Okay, so whatever price trading, automatically my trade will be executed at that price. Or I can put limit order. Limit order means I'll say it is trading at 1856.50 now. I'll put a order saying that buy this share for me after 1860. Okay, once it become 1860, then only my order will become active. Till that time, it would be passive order. So when you are putting an order into the market, you can either put active order or you can put a passive order. Okay, limit order. Passive order means limit order. So when you put a limit order, once it touches that price, that value, then value trade will get executed. So if you observe, like when you are trading in the market, you can do intraday or you can do overnight. Overnight means delivery. If you trade in delivery, you have to pay 100% of the money, whatever is the price of the share. But if you trade in intraday, you just need to pay 20% of the money. And to get one share of the Infosys, you just need to pay 371.837 rupees. But you never get the ownership right of the company. This is just like a rental. You are getting this share for rent within 3:15 p.m. Within 3:15 p.m., whatever movement you can capture it, make money and come out of that. If you are getting loss also, you have to come out with a loss. You cannot do anything because you never get the ownership right. You are just paying 20% to capture the movement on the stock. So when we do intraday trade, we can even buy, we can even sell also. So here we can even sell the stock also when we are doing intraday trade. Okay, but overnight selling is not allowed. Overnight you can see selling is not allowed. Okay, so when you are trading in the market, you can trade on, you can do intraday trade where you just need to pay 20% of the money. You will get 5 times of leverage. This is called 5x leverage, where you just need to pay 20% of capital. You just need to pay 20% of capital. Or what you can do, you can trade in delivery. Okay, or what you can do, you can trade in delivery. So when we trade in delivery means we are buying the share and by paying for 100% payment. And here only buying is allowed. You cannot do selling. Here you are making 100% payment and you are the owner of the company. Now you can hold this share. How long you want to hold, you can hold. So many people do swing trading. Swing trading means if you are planning to hold this share for 1 week to 1 month, and you believe that you will get your required objective, means whatever target you're expecting, you'll get within a week or month. And whenever you get the target, you will come out of the trade. This is called swing trading, or many people do positional trading. Positional trading means when you buy the share and you hold the share for 1 month to 3 months. You bought the share and you hold the share for 1 month to 3 months or 6 months, or you can do investment. So in investment, if you're holding the share more than a year, then it is called as investment. So it depends. When we are trading in the market, it depends that what we are planning to do. Are we planning to do intraday trade or we want to do delivery trade? What is our perception about the company? Always, if you trade in delivery, the risk factor will be very less. Okay, so it's up to you till whenever you want, you can hold the share of the company. And Rakesh Jhunjhunwala has bought one share of Titan around 3 rupees. Now the same share is trading in the market at 3,600 rupees. Although he's not there, but his wife is still holding the share and she can hold till whatever time she wants. And once if you're not there also, your share will be transferred to a nominee. Okay, and they can hold the share till whatever time they can hold. I hope you are getting. So when we talk about stock market, if you are trading on stock market, that is a secondary market over the stock exchange, we have a definite time period. Okay, within the definite time period, you can either do intraday trade or you can either do delivery trade. When you do delivery trade, we have to pay 100% of money. Okay, once the 100% money is paid, then you will get the delivery of the same share within a day. Not within a day, you'll get by a day. So we have T plus one settlement in a market. So whatever trading we are doing, we have T plus one settlement where today is the trading day on whichever shares you are doing. You are trading, today is a trading day, and by next day, your clearing of the trade is done over clearing houses. For NSE, the clearing house is NSECN, National Securities Clearing Corporation Limited. So it will take one day for the final clearing and the settlement of the share, and by next day, the share will be start reflecting in your account. So if you do any trade in delivery, so within the day you cannot sell that share because it will take another 1 days of time to do all paperwork, everything to be done in electronic form, and then we can perform any activity on the share if you want after the day. So we have T plus one settlement when we talk about the transactions, what we do on the equity market for delivery trade. So basically, you have understood that whenever we are trading in the market, you might have noticed that if delivery on delivery, if you have taken any share, you could not able to sell it immediately. So if you are having some kind of intention like that, better go for intraday trade only, because when we are doing intraday trade, we just need to pay 20% of capital, and anyway we'll exit from the trade within the day. If you have planned to hold the trade, then you can go for delivery trade. I hope the perspective of understanding delivery trade and intraday trade is clear with all of you. What is market order? What is limit order? Also, you have understood. Next thing is that whenever you're putting the order, the tick size is 5 paisa, means like imagine Infosys trading at 1856.40. So if you want to place an order, if you are placing a limit order, you cannot place 1856.39. You cannot place it 1856.38. You cannot place it 1856.37. You cannot place at 1856.42. You cannot place at 1856.43. You cannot place at 1856.44. The minimum difference of the price in paisa would be 5 paisa. Means your next order, next increase, next change in order would be either 1856.45 or 1856.35, and then 1856.30. I hope you're getting it. So that is called tick size. Like imagine if I'm placing order here. So imagine if I'm placing order here. If I place here 1856.37, that is not acceptable. And that is not acceptable. You cannot place the order. If you say 1856.55, that is fine. But if you are paying saying 56, that is not fine. It won't work like that. And a limit price should be in multiple of 5 paisa. Clear na? So I hope you have understood these things. So when it comes to trading in the market, you know that these many companies are trading, and you can buy and sell their shares during the market hour. You can buy and sell their shares. It become much more easier for us to do this. Now talking about IPO and all, you have understood about what is basically an IPO. So IPO is basically the process through which the company raise fund from the market. So whenever any company plans to come up with an IPO, uh, whenever any company is coming with an IPO, they have to create a document which we called as draft offer document. They have to create this document, draft offer document, and this draft offer document they have to submit to the SEBI before 21 days of the IPO. And in order to prepare this document, since the company don't have the financial knowledge to do all this paperwork, so they take the help of third party, which we'll call as a underwriter. We'll call them as an underwriter or merchant banker. We'll call them underwriter or merchant banker. Okay, we'll call them underwriter or merchant banker, or we'll call them as the book running lead manager. Book running lead manager. So these underwriter or merchant banker or book running lead manager, what they do all the paperwork of the company, and then they create this draft of a document which the company submit to the SEBI. And if SEBI feels everything is appropriate, then SEBI gives them a green signal that they can come up with an IPO. So basically, in the draft of a document, the company has to present their financials. They have to declare how they have performed in last 4 to 5 years, what is their balance sheet, P&L, cash flow, fund flow, all statements they have to disclose. They have to mention the reason why they're coming with an IPO, what they will do with the fund. Okay, all the required details they have to mention. And once SEBI give them green signal, then for the general public, they'll republish the same document, which they'll call as offer document, or that is called as prospectus. Okay, that is called as offer document or prospectus. Okay, this is called offer document or prospectus. And then since public don't have that much time and knowledge to read all this, so then they publish the abridged form of the same thing, which is called as RHP, Red Herring Prospectus. And by going to Red Herring Prospectus, we'll get to know a lot about the company IPO. Okay, and in case if you don't have that much time, also what you can do, there are a lot of websites are there, which give you some details about. There's a website called Chittorgarh. You can go to this website and it gives you a lot of details. Many IPOs are SME IPOs also. So better don't get into SME IPOs. Whichever IPO you want to prefer only main board IPO. Like I'm giving you an example of one company called Hexaware Technology, and they had came up with an IPO from 12 February to 14 February. Any IPO when it comes to the market, it will normally works for 3 days. And up to the CB rule, you can do an IPO till 10 days, but any IPO only is there for 3 days. And whenever company do an IPO, they have a time window of doing an IPO, and then it is normally 10 day, 3 days. And there is some fund what the company is looking to raise from the market. Okay. And then like you can see for Hexaware Technology, they're looking to get 8,750 crore from the market. And every IPO is a book building process, because in the book build process they don't disclose the price at which they feel is appropriate to do an IPO. What they do, instead of they are telling the price, they expect the market participants to decide the price by themselves. So for that they'll give a price band. Okay, so for Hexaware Technology also you can see the price band. Okay, you can see the price band is from you can see the price band is from here it is written 708 rupees. Okay, the price band is they're given the price band that would be low price and upper price. They'll always give you a price band. Okay, so this is around 695 to 708 rupees. Okay, this IPO price band was 695 to 708 rupees. Okay, so where the lower price is called cap price, floor price, and the higher price is called cap price. So always, whenever any company come up with an IPO, they'll follow a process that is called as book building method. So in the book building method, company don't disclose the what is the appropriate price for the IPO. Instead of their uh, mentioning which is the appropriate price, they'll give you a price band. Like for Hexaware Technology, the price band is 695 to 708, where the smaller, this is called floor price, and this is called cap price. And this kind of event is called Dutch auction. Okay, this is called Dutch auction, where I have given you floor price and cap price, and the difference between them cannot be more than 20%. And they follow book building method, where during these 3 days, three kinds of investor participate. Either you can be retail investor. Retail investor means if you're bidding in IPO less than 2 lakh rupees, then it is called as a retail investor. While if you're bidding between 2 lakh to 10 lakh rupees, then you are called as HNI. HNI full form is high net worth individuals, or you can be called as NII. NII means non-institutional investor. And third kind of investors who can participate are your big financial houses, which we call as institutions. So institutions are there, retail investors are there, HNIs are there, which participate in any IPO. So when any company come up with an IPO, they'll give you the price, the issue price, the issue size of the IPO, and they'll mention that some percentage of the IPO would be fresh issue and some percentage would be offer for sale. For Hexaware Technology, you can see it's 100% offer for sale. Offer for sale means whatever fund they are raising from the market, they'll take that fund back. Okay, they are not going to put that money back into the growth of the company. Okay, that is called offer for sale. Okay, so like Hexaware Technology parent company, whatever fund they will get from this IPO, they'll take that fund and they'll do whatever they want to do. Okay, they're simply giving their ownership to you. Okay, this is entirely an offer for sale. Okay, the same thing Hyundai Motor India has done when they came up with an IPO. Fresh issue means the whatever the fund is fresh issue, that much percentage of the money they reinvest in the growth of the company. Means money is not going anywhere. Whatever money you are giving as an investor, you're giving to us, you're putting that money into the company. We are not taking that money. But if it's an offer for sale means the company is taking that money. And what company will do? They are just giving their ownership to you. The promoter, they're diluting the ownership, and that percentage of ownership they are giving to you. So after every IPO, like this IPO is between 12 to 14 February. On 17 February, it will be decided that you got the share or not. If you do not get the share, your fund will be refunded to you. If you get the share, then this company would get listed on 19 February on Wednesday, or at 10 o'clock in the morning, you will start seeing the stock in the stock exchange. Clear, everyone? So whenever you are putting money in an IPO, you cannot buy one share. You have to buy minimum one lot, and that one lot it can be n number of shares. For Hexaware Technology, the one lot is 21 share. So if you multiply 708, which is a cap price, with 21 rupees, you will get to know the amount what is required to get one lot of the company. Normally, for retail investor, one lot is equivalent to the nearest value, which is multiple of 708, nearest to 15,000, lesser than 15,000. It won't be 15,000 or more than 50,000, lesser value than 15,000. Okay, that would be the value of one lot, and retail investor can buy till 2 lakh rupees. Oh, okay. So you can see for retail investor, they can buy between one lot to 13 lot. And for HNI or NII, they can buy from 14 lot to whatever. They can buy from 14 lot to how many lot you can see 67 lot. Yeah. 14 lot, the minimum lot for HNI is 14 lot, and for BNNI it is 67 lot, means above that, and above that 10 lakh rupees. And so you for employer are getting some discount. You can see the book running lead manager for the company face value is 1 rupee. Face value basically means if the company will get bankrupt tomorrow, what value they will give you per share. That is the face value. They are taking 708 rupees per share from you. But if they will get bankrupt, they will return back only 1 rupee per share to you. Okay, employee discount and other details are given here. You can read about this. You can go down and read about the financial of the company. Everything is given, and you can compare the assets, their revenue, their profit after tax, net worth, reserve and surplus, borrowing. Okay, you can see this. Okay, this will give you an idea about the doing the fundamental analysis of the company. You can see the asset is increasing on year basis. Revenue has not given that much significant growth. Yeah, asset revenue, uh, they are increasing, profit is increasing, everything is increasing based on reasonable level. So it's okay. You can do a peer comparison where you can compare this company with its competitor and get to know like based on financials figure is good or bad. You can see SMC Global is saying neutral. SBI Capital is telling apply. Marwadi Shares and Finance is telling apply. Ashika Finance is telling neutral. Capital Market is telling max apply. People are giving their own what you say review based on this. So you can see that six people are like out of review. Around 66%, two-third people are telling that better buy this IPO. It's a good IPO. So everyone is giving their own perception about this. You can see the peer comparison of this company with this competitor, the EPS, NAV, net asset value, price earning ratio, return on net worth, and other details to understand about EPS, NAV, RONW, PE. We'll discuss later on. But if by doing all this thing, you can get an idea about the IPO and all. You can also do the calculation about the GMP also. How much is the GMP? Okay, how much is the GMP of the company? GMP will tell you that percentage gain what you can get if you get the share of the company. So if you are putting your money for speculative purpose, so on the day when it will get listed on 19th, on that day, on that moment, if you sell this share, how much percentage gain you can get, that you can understand if you see the GMP. What is the current GMP percentage? You can see this. Yeah, in Live Mint and other newspaper will give you that data. So you can see this. Made a high of 20 rupees and against 11th February GMP was 2 rupees. Now GMP is around 20 rupees. It means that the company one share is there in the market at 708 rupees, and now if you're putting your money on this, what gain you can get from this means 708 rupees will max to max will become 728 rupees. So the 15,000 rupees of investment, what you are doing, okay, you are buying for 708, max to max, it will become 728 rupees. So if it becomes 728 rupees, if you are getting 21 share, so and imagine luckily the moment it got listed, if you sell it, so how much value you will get from that if you calculate this. Okay, if you calculate this, you will get around 15,000 288 rupees. So around near about 15,000 investment you are doing, 14,000 some money, 14,000 some was the value. Okay, and you will get a appreciation of around you can see around 15,000. So not much big figure. 20 you can calculate now. 20 you can calculate calculator if I open. 20 divided by 708. If you do near about 2 to 3% gain, you will get. So if you really want to take risk of 2 to 3%, you can put your money in this company IPO. Otherwise, anyway, this company will get listed on 19th. That day, you can buy the share of the company and you can stay invested till how long you can do. So whenever any company come up with an IPO and all, so IPO is giving you an early window to buy the share of the company. Imagine if you do not participate in IPO also, not a issue. You can buy the share of the company once the company get listed in the market. So whenever any company uh, raise money from IPO, it is called primary market. And once its IPO is over, after a few days, the company will get listed in the market. And then we can buy and sell the share of the company through secondary market in stock exchanges. And then proper transparency would be there. Once the company get listed in the market, all financial information of the company would be available in public domain. And then decision making ability would automatically will improve based on the all financial knowledge and information. An investor can choose either they should invest in that company or not. Okay, so whenever we put our money, uh, buy any share of the company, what we can expect from the company, either we can expect dividend or we can expect capital appreciation. If payment of dividend is not a compulsion for the company, If the company want, they will reward us in the form of some benefit, which we call as dividend. The other benefit what an investor can get is the capital appreciation. Capital appreciation means the price of your share is would appreciate in the future. And by that, when you sell that share in the future, whenever you want, you will get a value of the money. That is what we call as capital appreciation. So guys, I hope you have understood what all we have discussed in this class. So it's time that I should wind up this session. Thank you everyone. I'll see you all in next video. Take care. Bye everyone.